They know that the competitor of tomorrow, if he's going to be tied down to branch banking, he has no hope to be able to give them genuine competition. And that probably is one reason why established banks everywhere are so big, so unwilling to change, even unwilling to listen to the consumers, and why they become lazy. Why they slap on the margin of 3% and go to play golf at 3 p.m. But this is going to change. The main driver, as I said, is ICT. The other driver, the other key driver, is what bankers themselves are doing. This is the global financial crisis. There was a time when every week you hear about new hefty fines being paid by a bank somewhere for taking liberties with the kind of franchise that they have been given by their particular governments and their regulators. The heftiest fines in the world have been paid by banks for issues like mis-selling, rate reading, all kinds of misdemeanors you can think of. They've done it. There were times when this one well-known bank, I hope you know here, was blazing from the billboards everywhere. They have the best fixed rates. Now we know what they meant when they said best fixed rates. Bankers have become fixers. I hope the CEO of HSBC, who's also chairman of NBA, will not mind, I say half jokingly, HSBC is the world's leading bank. The wags are calling it Hum Sabse Bada Chor. Translate for you, we are the biggest thieves around. So the world's biggest bank, HSBC, Hum Sabse Bada Chor. So I hope this kind of image that bankers have built up. Bankers, sector is characterized by bailouts and blowouts and mergers and acquisitions. You name it, one of most countries in the world have got this kind of problem. The latest was in Spain, was it Portugal? The Espírito Santo also grew up. And banks become wards of the state, need to be bailed out by the public first. So all these things have provoked lots of thinking, rethinking about how the banking sector is regulated, which is also the thing I like to talk about, how the shape of regulation will change. But banking itself, as we know it, will not look like anything that we know today. There will be no physical banks. There will be probably fewer sort of clearly identifiable banks as such. I see the line between financial services providers and traditional banks becoming fuzzier and fuzzier. Now we are told that if something sort of looks like a bank, we should regulate it like a bank. But many of these things will not look like a bank. You know how they put it in colloquial language. If it walks like a duck, it quacks like a duck, it must be a duck. So in the case of banks, it won't look like a bank. It will just be doing a different part of the banking activities, which are now conducted by banks. So I see a future where there will be more specialized players. There will be niche players. And here in Mauritius, we have started moving in that direction. We do not believe that the universal bank license serves our purpose anymore. We think technology makes it easy for people to compete in areas where they are more competitive with the big monolithic banks. So that's why, some time ago here in Mauritius, we moved to amend our legislation to provide for a differentiated license. Before we had one single bank license. We changed that in 2007 to allow for an Islamic bank license. In 2010, we made further changes. We allow for a private bank, standalone private bank, and we allow for an investment bank. So I hope that we'll continue this process of enlarging and continue in such a way that we bring in our fold all other connected activities that support and supply the banking activity. Unfortunately, in Mauritius, as all of you know, the Bank of Mauritius does not regulate the banking sector as a whole. Many parts of the banking sector escape our control. Now we know what happens when you have too many regulators in a particular field. The prime example of what can go wrong is again the United States, where you have nearly 1 dozen regulators involved in different aspects of the banking and financial sector. And the blow-up happened in the US. So we feel that in a small jurisdiction like ours, there is no need to have multiple regulators. And because technology now is making the lines separating banking from non-banking become fuzzier and fuzzier by the minute, there is pressure to try to unify our regulatory approach. So by 2030, I hope that we will have one single regulator for the entire banking and financial services sector. That will go beyond the NBFCs, that will include things that are becoming very important to banking, but that are not currently regulated by the banker, by the central banker. For example, everything concerning the payment space and payment systems are very loosely regulated, not just here, internationally. Credit cards, for example, very important. Maybe the most important innovation in banking was credit cards. Not the ATM, as Mr. Walter said. But credit cards almost get away without regulation. Luckily, there's competition. So competition keeps them from exploiting customers. And now technology is making more inroads in the sector occupied by credit cards. The bank of the future will not be running bank outlet. It won't be running its own cash machines. It will be outsourcing all that. And if it outsources all that, somebody, somewhere, must regulate the provider of the outsourced services. Because the systemic risk will be transferred from the banking space to the non-banking space as well as the banking. So we feel that there is strong pressure going to come to regulate the entire spectrum of activities in the financial space, which stretches beyond banking to non-bank financial services, to capital markets, to the insurance sector. You will not be able to define all that. If you take that together with peer-to-peer lending, then you must provide a different way of trying to standardize contracts between the lender on a peer-to-peer platform and the borrower on a peer-to-peer platform. These have implications for everybody involved in the sector, whether it's the lawmaker, whether it's the judiciary, and whether it's the regulator, as we know them now. And of course the regulators, the rule book must change. Already, I mentioned earlier that one of the drivers of the change is going to be the fallout from the global financial crisis. The fallout is taking the form of the Dodd-Frank legislation. Last time I heard, the rules that had actually come around to writing was running to 3,000 solid pages. And there's more to come. So by the time you finish writing the rule, there'll be thousands, tens of thousands of pages of regulation. So I see the future of banking in a current space as being one, there will be re-regulation. That's the immediate future, not 2030. There will be pressure to re-regulate, partly because bankers have brought it on themselves. Bankers are the people who brought you the spectacular bust-up of the global economy. So they are going to get much more regulation before things are going to improve. And among the things also happening right now, as I said, is the possible blow-up of the banking space to allow new players, less regulated compared to what we have now. Now we have very well-defined banks, very well-defined regulators. Even globally, we have Basel Committee on Bank Supervision. All that is going to change because you will not be able to regulate the space much longer in that manner. So writing more and more complicated rules is not going to be part of the solution. It requires the regulator to be fully abreast with technology and to be fully aware of what is going on across the entire spectrum of financial activities. Our bankers are for the job. Our commercial bankers are for the job. Is the traditional bank as we know it now likely to survive this twin onslaughts from technology on the one hand and the pressure to re-regulate coming from the global crisis. That, I think, is a challenge for regulators, not just domestically, but internationally. So the banking sector of the future is going to be a very challenging one for all of us. Maybe we'll be dealing with a bank that is not that well regulated. Already as it is, many of us have difficulties with banks. That's the reason why, for example, we set up a task force of the Bank of Mauritius to try to address the kinds of grievances that many bank consumers have been writing to us about. I asked my colleagues to provide some copies of this document, so I hope they will be able to pick up a copy. I must clarify that we are not doing an exercise in bank bashing. So our colleagues from the banking sector, be aware that this is not bank bashing. We want to bring banks and bankers back to basics. Why you have a license to practice banking? It is to service the consumer and the customer. We want to put the customer back at the center of your preoccupations. We understand that your bottom line matters, and you have to look at the bottom line. We do want you to make profits, and we are happy to make profits. So I'm sure if you look at the different themes that we have brought up there, none of us here disagrees with it. But why, when we wear our banker's hat, we go back, we become greedy? Why do we widen the margin between our cost of funds and the cost of lending? Why do we do that? When our NPLs have come down, they have been rising slightly recently, but they have come down. If you start with the MCID loan to Mauritius, they came down to less than 3%. They are rising a little because of the effect of the crisis. So we feel that some of that should be shared with the consumer. Competition is not doing it because you brought in new players. Because of the legacy cost of the large banks and sheer access and the difficulty of switching banks, it's very difficult to rely on competition to give the consumer their need. So we believe more is required. We want an efficient banking sector. We want an efficient financial sector. We want the cost of intermediation to come down. We do not want the financial sector to be the most profitable industry around when the real sector is hurting. The interaction with the real sector must determine your profitability as well, because you are there to serve the needs of the real sector. So we believe that the change that is coming will make the banker of the future more attentive to the needs of his customers. We want you to treat your customer fairly. We want you to listen to your customer more. We want you to accompany him.